Is America riskier than we think? For decades, the United States has enjoyed the reputation of being the safest place on earth to invest, thanks to its political stability, rule of law, independent institutions, and economic dynamism. This status has granted the U.S. what economists call a safe harbor premium, meaning it can borrow money more cheaply and attract more foreign investment than other countries. The assumption in global financial markets has long been that the U.S. carries zero country risk. However, a growing body of evidence suggests that this may no longer reflect reality. Economist Ernie Tedeschi, in a recent report from the Budget Lab at Yale University, argues that America's true country risk premium is likely higher than investors assume. His model, based on aggregated assessments from political risk experts, suggests a shadow risk premium of between 25 and 35 basis points, comparable to about half the level the UK experienced following the Brexit referendum. Since 2016, U.S. political risk has steadily increased due to factors like election denialism, government shutdown threats, trade disputes, and rising institutional mistrust. Yet these risks remain largely underpriced by financial markets. Yield spreads between U.S. bonds and those of similarly stable countries like Canada remain narrow, and investor surveys show little change in capital allocation behavior, despite expert warnings. The economic consequences of a risk reassessment could be significant. Even a modest increase in the perceived U.S. risk premium, say to 35 basis points, would lower real GDP by about 1% over a decade, with average household wealth dropping by $15,000 to $50,000. In the event of a more dramatic shock, such as a crisis 3 times the scale of the 2011 debt ceiling standoff, the impacts would be far more severe. Real GDP could fall by 3.5%. Nearly 9 million jobs could be lost, and household equity wealth could plummet by over $200,000. These are not just abstract models. They reflect potential real-world consequences if America's political environment continues to deteriorate, or if markets suddenly reprice U.S. assets to reflect rising instability. Despite these risks, the U.S. dollar remains strong, trading 17% above its 20-year average relative to major global currencies. Investors still treat U.S. Treasuries as the global benchmark for risk-free assets. The country's economic strengths, its productivity, innovation leadership, and deep capital markets still make it an attractive destination for investment. However, this strength may be masking deeper institutional vulnerabilities that, if triggered, could disrupt the global economy. Experts are increasingly warning that America's risk profile may be changing beneath the surface. Central bank independence, long a pillar of U.S. economic stability, has come under political pressure. Trust in electoral integrity has declined. The rule of law and media independence are being questioned more openly than in recent memory. While the markets might still see the United States as the cleanest dirty shirt in a world filled with political turmoil, that perception could shift rapidly if another major institutional shock occurs. In short, America may indeed be riskier than we think. Not because it lacks economic strength, but because its political volatility and institutional trust deficits are growing. If financial markets start to take those risks seriously, the consequences for economic growth, wealth, and global influence could be profound. The U.S. must not take its safe harbor status for granted.